I'm Rusty Dornin from the Kaufman Fellows Academy, and very honored to welcome back, but really for his first round for the Venture Deals 2 course, Brad Feld, the author and, of course, instructor of Venture Deals. And while most of you, of course, know who Brad is, you may or may not know that he really has launched something called the Startup Revolution and a series of books, Startup CEO, Startup Boards, Startup Communities, Startup Life. The list goes on. And Brad, are there going to be some other ones coming up?
Yeah, we've got a few more coming. The next one in the series is called Startup Metrics, and I'm writing it with my Foundry Group partner, Seth Levine. We'll have it coming out probably end of this year, beginning of next. We also have a book coming out from FG Press, which is a publishing company that we started last year that's now published a couple of books. The first two are a fiction book called Uncommon Stock. It's a startup fiction. And the second book is a book called Sleep Your Way to the Top and Other Myths About Business Success that's written by a CEO, Jane Miller, who's an awesome entrepreneur CEO who just sold her most recent company. And in that, from FG Press, we have a book called Startup Opportunities that's coming out this fall, and it answers the question of that a lot of entrepreneurs ask all the time, which is this a good opportunity or not? It's meant to be a companion to books like The Lean Startup or The Lean Launchpad. It's not a methodology for figuring out and iterating through the very beginnings of your company. Rather, it's a way to answer the question, is this something I should spend my time on or not?
You know, and just real briefly, before we really jump into this, you seem to have a very strong philosophy about trying to foster relationships between entrepreneurs and investors. Can you just talk about that just a little bit, what your philosophy is on that?
Sure. I think that the role of an investor is to unambiguously support the entrepreneurs and the CEO, often the founding CEO. And as long as the CEO is supported, it's the job of the investor to help the CEO and the founders succeed in any way possible. If the investor for some reason no longer supports the CEO, it's the investor's job to do something about that, which doesn't necessarily mean replace the CEO. But if you start from that frame of reference, as an investor, I think it's super important for the relationship between the investor and entrepreneurs to be an authentic one, an honest one that doesn't have passive-aggressive or passive avoidance behavior in it. And a lot of what I spent my time on in the last decade or so through things like Techstars, as well as our investing, is working hard to create context where investors and entrepreneurs are really working closely together to build great companies, rather than a one-up, one-down relationship where the investor views the entrepreneur as working for him or her, or there's this continual friction point between the goals and desires of the investor and the goals and desire of the entrepreneurs.
I mean, that kind of jumps into even one of my first questions, and that is, you talk about the importance of verbally discussing issues, like valuation, that sort of thing, before you jump into writing things down. Should investors and entrepreneurs just be talking more before they jump into putting things down on paper?
Yeah, I think there's an endless cat and mouse game that gets played between two parties when they're trying to figure out whether there's a deal to be had, whether it's an investment or an acquisition. I think when you think about that, enormous amount of emotional energy is often wasted in that. I try to get rid of as much of that emotional energy in the game, and instead focus on putting the emotional energy into building the relationship. The terms of an investment, as you learn from this course and from Venture Deals, really fundamentally come down to economics and control. Economics are pretty straightforward. Control is pretty straightforward. So there's lots of different ways you can dance around that sort of thing. But as an investor, having a direct relationship with the entrepreneur in a lot of ways is way more important than the legal documents. And for the entrepreneur, understanding what the character of the investor is, how that investor is going to react to things, interact with you, oftentimes is a lot more important than the legal documents. So I think building that relationship, however you build it, right? However, as an individual, your style works is way more important than sort of diving into the exchanging of term sheets and trying to negotiate over specific points, which in a lot of cases are either irrelevant or not the the leading issue that needs to be resolved in a new relationship that's coming together.
Okay, so we have a few folks that have joined us and a question already, so we'll jump into the question. How do VCs build their deal flow? How do they start building their deal flow? In parentheses, being noticed by entrepreneurs and being attractive for entrepreneurs.
It varies. It varies widely. Before I answer the question, I want to create a frame of reference, which is the notion of a VC is not a singular archetype. There is not a VC archetype. There are many different kinds of VCs, and in addition to VCs having, investment, different strategies and different stages that they like to invest in, they have different experience bases, they have different backgrounds, they have different skill sets, they think about problems different ways, they interact with people different ways, they have different value systems. I like to think about VCs as Dungeons and Dragons characters. For those of you that are old enough to remember Dungeons and Dragons, if you're not as old as me, then maybe Magic the Gathering characters. Instead of thinking it as a single archetype, think of VCs as being, dwarfs and orcs and elves and mages and wizards. And in fact, a venture capital firm is not a single archetype either. It's often a collection of different archetypes. So just for starters, there is no singular archetype of VC. Now, the way VCs generate deal flow varies widely, and it has a lot to do with the historical experience of that VC, the types of investments that VC likes to make, and the network that that VC has. So, for example, in 2014, my partners and I at Foundry Group have had for the last 7 years a very well-defined, very public strategy of what we invest in. And as a result of our strategy, which we describe as thematically based, we've generated an enormous amount of inbound interest and reputation around the kinds of themes that we invest in. In contrast, an associate at a venture firm who's just started and is fresh out of business school, but might have, before he or she went to business school, worked at Google or worked at, Cisco, probably has a network from their time and their experience working at those companies, as well as their business school network that they're using, plus then whatever the network dynamics of their VC firm to generate deal flow. So I could give 30 or 40 different tactics associated with it, recognize that it's different for every investor.
Okay. We have another question from a viewer. What do you think of a 5-year subordinated note with a 2-year warrant attached to passive investors?
Context helps. If that's a seed investment and that's the first money in a company, a 5-year subordinated note seems like quite a long term for a note, and especially if you're taking a note from a seed investment, you'll typically want that note to convert into equity when you have an equity financing. We talk about this a fair amount in venture deals around the convertible note section. So, the idea that you're raising a seed round, an early stage round through a note is a good idea, but you'll want that note typically to have a shorter term and to convert into equity. The shorter term, by the way, is probably less important than the convert to equity. If the person says, I'm fine with it being a 5-year term, but when you do your next equity round, it converts into equity with 20% warrant coverage or a 20% discount, that's better. If you're a more mature company and you're looking for convertible debt as a long-term debt instrument, sure, that's fine. So I'm not sure the term is the thing I'd focus on. 20% warrant coverage is certainly appropriate. The key for a startup is you don't want to have debt hanging out there. You want a way to convert that debt into equity when you actually do an equity financing.
Okay, our next question. Thanks for making yourself available, Brad. Is there a path for someone not with traditional pedigree to transition to venture capital as a profession? In my case, a major level A&R executive, which I feel displays similar DNA.
Sure. First of all, there's not really a profession called venture capital. It's kind of trendy to talk about venture capital again. There was a period of time not so long ago when venture capital wasn't particularly trendy. It's not a big industry. There's not a lot of venture capital firms, and there's not a lot of people who are venture capitalists. And as a result, there's not really a path to it. There's an ongoing argument about whether VCs are better if they've been operators versus VCs are better if they've been people who have always been in finance. I don't think that that's an interesting argument, so I kind of refuse to engage in the argument. Whenever somebody says which is better, the answer is either can be great and either can be really crummy. I know lots and lots of people who are venture capitalists and who are venture investors who have lots of different backgrounds. So this notion of there being a traditional path is one that I probably reject. It is true that there are quite a number of a larger percentage of people who become part of the venture industry do it by being business school grads that then get hired as associates in venture firms. That's a particular type of role. It's still a relatively small number of people. What I tell people who want to get involved in venture capital or investing in general is just figure out a way to get engaged. If you have some money, start making angel investments. If you don't know where to start making angel investments and you want to get involved in tech companies, just go to AngelList and start paying attention to what's going on AngelList and immerse yourself in it. Become a student of what's going on. Build a strategy of how you're going to invest. Do some small investments. If you're in a city where there's a lot of activity around technology, get involved in some of the things that are going on. If there's an accelerator like Techstars or something else in your city, get involved as a mentor and participate in it. If you're from another industry and you want to become more involved in entrepreneurship, just start. Get involved in some companies, either full-time or as an advisor, if you have something to bring to the table, and everybody has something to bring to the table. Engaging and participating is the right path to getting involved in entrepreneurship and investing.
Okay. We have quite a few questions today. When do you think it makes sense for founders to have some portion of their stake in preferred stock?
Usually, I don't think that there's typically a case where it makes any sense unless that the founder is investing in a round alongside of venture investors or angel investors. So, typically the structure is that founders get common stock in the company, and then as money comes in, you get preferred stock. As you know from taking the course, the definition of a preferred stock varies quite dramatically. You can have a very lightweight preferred stock that really has, little to no protected provisions, a simple liquidation preference, no extraordinary voting rights. Or you can have a very heavy or very complex preferred that has participation and has all kinds of control provisions and voting rights. Ordinarily, what you see is that preferred instrument is structured that way for a couple of reasons. One, obviously, is that the investor has the ability, with their investment, they want to have some additional rights that a normal common stockholder doesn't have. Founders typically have those rights or some element of those rights based on their ownership in the company or the board presence that they have early in the life of the company. As you raise more money, that gets diluted and the dynamics around that can change. Secondarily, you often have a preferred instrument so that you can price the common stock at a much lower price. We talk about this a little in the book around 409A valuations, but the idea is that you want to be able to issue options to your employees at a much lower price than the preferred stock, and the preferences that the investor stock have or the preferred stock have allow you to do that. So it's pretty atypical to see founders getting preferred stock, except in situations where they're investing their own cash alongside investors in a round.
Okay. How do you personally approach an underperforming company? Do you influence the entrepreneurs when you think they must take action? How do you deal with lasting divergence between the entrepreneur and you?
A couple questions in that. The nature of entrepreneurship and investing, especially at the early stages, that lots of companies are going to be underperforming, and that's the nature of the beast. And a lot of those companies that are underperforming are ultimately going to fail. When I first started investing, and I didn't really have a lot of experience with failure, when I'd have something that was a company that was struggling, it often generated a lot of anxiety and stress. I wouldn't say so much anxiety and stress that I spent all my time in the bathroom throwing up. But this sort of innate desire to sort of get involved and fix things. Sometimes I could have some influence on it. Sometimes I couldn't. As I've had more and more experience, you start to view the path as one where underperformance in some ways isn't really that important of a phrase at the early stages. It's just messy. Whatever your expectations are at the early stages of a company are probably wrong. And the path you're on is not one that you can predict and measure in any sort of way. It's very chaotic, up and down, dynamic. I like to say in my world today, I'm an investor in a lot of companies, something in my world something new, every day is fucked up. So every day I'm presented with something totally new, totally unexpected, that's totally fucked up from somewhere. And if by 4 o'clock in the afternoon it hasn't made itself apparent to me, I start to be curious where it's going to come from. And so it's not that you become immune to the stress or the struggle, it's that you can compartmentalize it and you recognize what you can or can't do as an investor to influence it on a positive path, to help the entrepreneur work through the problem or to directly address whatever the conflict or issues are. The second question is what happens when things with the entrepreneur diverge, the investor and the entrepreneur's views diverge. And it varies a lot as to what you can do and should do. There are situations where the right answer for an investor and for a board more specifically is to replace the CEO, to fire the CEO and replace the CEO. That's one situation. Another situation is that you realize that you don't have the right people on the leadership team. The CEO might be right, but he or she's not being supported by the right team, so you work with the CEO to help build out the leadership team. Sometimes it's a crisis. You have some kind of crisis, whether it's a self-inflicted crisis or an external crisis, and if you have a diverging viewpoint on how to handle that crisis, as an investor or as a board member, you have the ability to influence the thinking of it, but you can't demand that certain thing happen. And in some cases, the right answer for an investor, especially an investor that has a relatively small ownership in the company, is to disengage and not try to control or drive the outcome. So it varies a lot based on circumstance. And personally, for me, what I try to do now is I try to be, the calm thinker in the room as we identify what the root cause of the problem is, and then try to figure out the best solution to the root cause of the problem, and then support the execution of whatever that best solution is.
Yeah, and this next question kind of goes back to when you were talking about how to get involved to become an investor and that sort of thing. And I know the laws around this are changing, but the question is regarding becoming involved in investing like through Angel List, isn't the accredited investor rule an issue for getting started?
Yeah, it is an issue. So if you're not an accredited investor, it's actually continues to be difficult to close to impossible to invest in early stage companies. Accredited investor, for those of you that don't know what that means, is there's a set of rules defining an accredited investor. You have to have either individually made over $200,000 a year, with your spouse made over $300,000 a year, have a net worth not including your house of over $1 million a year. If you check a certain set of those boxes, you're accredited and you can legally invest in startup companies. There was an effort, or is an effort, with something called the Jobs Act, which was passed 2 years ago, to change that dynamic. There's a type of regulation, 506B and 506C. 506C is the old rules using the accreditation that I just described. 506C allows some new dynamics around those rules, including something called general solicitation. And then there's a separate set of things around crowdfunding, where the idea of having the ability to relax that accredited investor threshold and have people that have lower than that accreditation invest in companies is still being worked through a couple of years later. And many of the second order effects of the expectation of what could happen there are struggling in the morass of our political system in the SEC and theoretically protecting people from themselves. So it is true there's a lot of nervousness amongst some angel groups about the accreditation rules, the thresholds increasing. You'll hear some noise about that. Essentially, the way I like to describe it is if you have no money, then you shouldn't be investing money. You should be investing your time and energy in these companies. If you have money, you should be investing amounts that you can assume that you can lose 100% of it. So if you're investing money that you can't lose 100% of, you shouldn't be investing in other people's companies with that money. And again, you should be in that first category, investing in yourself, creating things from scratch, trying to generate some of that initial wealth.
Okay, next question. Do VCs always invest in deals with preferred stock, or can it be they accept common stock?
Some VCs accept common stock. I'd say the vast majority of early stage investments through the life of the company is preferred stock. You see investors buying common stock in three situations. Occasionally at very early stages in a company, you'll see common stock. And you'll see that also from programs like Techstars, where they're investing at a pre-seed level, where they're really helping co-found the company and providing, in the case of Techstars, if you're not familiar with it, a mentor-driven accelerator program for 90 days. They give the company a little bit of cash and they get some equity in common stock in exchange for the program and the cash. So sometimes you see it at very early stages. Oftentimes you see it at very late stages, so pre-IPO, or in a situation where the company's valuation has increased dramatically and there's a lot of competition to invest in the company at that later stage. You'll occasionally see some investments in common stock. And then the third is that what's called a secondary transaction, where investors are buying shares from existing or former employees, where they're buying common stock from those employees rather than investing directly in the company.
Okay, we have a sort of general question about your own philosophy. What is your goal, mission, purpose as a VC except to make money?
Well, the make money, I'll define what make money means because I think that's important. I like to say that my job is simple. I have investors who include me and my three partners. We put money in a box, and our job over time is to return to our investors a bigger box full of more money. That's it. That's the job. So all the stuff we do in the context of that is in support of that job. I happen to believe that we get to choose. I'm fortunate I get to choose what I want to do with my time, and there's lots of different ways to make money, and plenty of legal ways to make money. And there are easier ways to make money ways to make more money than being a venture capitalist. So for me, a lot of what I do is I love the experience of working with people at the inception of an idea, and turning that idea and going on a journey to turn that idea into a significant, meaningful, long-lasting company that has impact. And some of those companies are companies that have impact on the world in terms of how people use the products, and have very, very broad impact. In other cases, they might have impact on a community or a set of employees that work for that company, or a certain type of users. That process of being involved in taking something that was nothing but an idea and translating it into something that has some meaning is incredibly satisfying to me, and that's how I like to spend my working time, recognizing that the way I choose to do that economically is in this role as venture capitalist.
And again, I think that comes out in many of your books, your philosophy around that, of fostering community and building communication between the two sides instead of animosity or that sort of thing. Are there clauses in a deal term sheet that make it unfundable for further rounds of financing?
Yeah, there are, although sometimes further rounds of financing will clean up the things in the earlier rounds, or you'll have to have a rough negotiation with your investors as you go through that. A general principle, especially early, is that the more stuff there is in the deal, the harder your next rounds are going to be. And in a lot of cases, the worse they're going to be for the entrepreneurs. So simple is better, especially early. An example of that would be participating preferred at the beginning is a term that everybody may look at when you raise $1 million and say, it's not a big deal. The investor gets $1 million off the top, and then they get their share of common stock. And if we sold the company, for $10 million or $11 million, it's not that big a difference between the two. But if you've raised $50 million of capital and that participating preferred term rolls all the way through every subsequent round, so all of a sudden you have $50 million of participation, a $100 million deal really is a $50 million deal because the first $50 million goes to the investors. And a $150 million deal would really be a $100 million deal because the first $50 million goes to the investors. So trying to keep things very simple at the beginning And making the trade-offs on simplicity matters a lot. Another thing to watch out for is the challenge of having different investors having different incentives. So investors will invest at different prices. Hopefully you're making progress in the life of your company and the price goes up of each subsequent round. But if you have investors that have widely different outcomes based on what the price is and what the terms of their round are, and those investors have different control provisions over what can or can't happen, you might find yourself in a position where not only if you're selling the company are you negotiating with the acquirer, but you're also having to engage in a negotiation with and between your existing investors who are in different classes of stock and have different rights. So again, try to keep it as simple as you can for as long as you can through the life of the company.
Well, we know valuation and price is obviously a key issue in the economics and the term sheet. Yeah, let's talk about what are some of the valuation traps that first-time founders can fall into.
It's a couple of important ones that pop up all the time. The first is pre-money or post-money. I can't tell you the number of conversations I've been in where somebody says my valuation is X. I've got a $5 million valuation, and I'm raising $1 million. Does that mean that $1 million buys 1/5 of the company or 1/6 of the company? Right? Are you really raising money at a $5 million pre or a $5 million post? If you're raising money at a $5 million post, obviously the investor is buying more of the company than if you're raising it at a $5 million pre. So understanding pre and post money matters a lot, especially when the numbers are small. Be more dramatic. I'm raising $1 million at a $3 million valuation. Right? Am I selling a third of the company, which would be $1 million at a $3 million post, or am I selling a quarter of the company, which would be $1 million at a $3 million pre? Another valuation trap is the notion of an unissued option pool. Typically, early in the life of your company, you'll have baked into your cap table options that have not yet been issued, and the idea is that they're part of your current valuation with the idea that you're going to issue them in the next round, over the course of the next 12 to 18 months. Are your options pre or post money? If 20% of your company is in options, but it's pre-money, and your pre-money is $3 million, really your pre-money is $2.4 million, because 20% of your company is equity that hasn't been issued yet, versus if your options are post-money, they get added onto the back of it after you've had that evaluation, so you don't get the additional discount for it. Those are the two biggest, and those are both negotiations, and they're both places where oftentimes you see entrepreneurs not realizing the implication of exactly what they're saying until after, it's sort of played out and you're now deeper into the term dynamic.
Okay, we have another question from a viewer. It seems that in the U.S., startups asking help from fundraisers have less chance to raise. Why? In France and Europe, it's much more accepted.
Well, it varies. I think in the U.S., the general view is that if you're an early stage company, having an agent or a promoter helping you raise your round is both unnecessary because of the capital dynamics and generally is a negative indicator of the capability or confidence of the entrepreneurs. It's also, it also is costly. I mean, if you have somebody helping you raise $1 million and they're charging you a fee to help raise the $1 million, that whether they're taking in equity or in cash, a new investor comes in and looks at the person who's helping you raise money and says, why am I giving that person money for something that shouldn't be that hard for the entrepreneurs to do? Later on in the life of the company, when you're raising a late stage round, you'll often see a banker involved in that, and that's mostly just to help manage a process for a very fast-moving company. In the same way that the IPO process tends to have investment bankers involved in it. But I would say, generally speaking, especially at the early stages, having some sort of promoter or agent is adverse selection. It creates an adverse selection perception for companies. The last thing I tell you is that there's an awful lot of people who say they can help you raise money and they suck at it. And so what they're doing is they're actually hurting you. And so you get excited because this person says, hey, I'll help you raise some money. Well, the best person to help you raise money is somebody who's writing a check. Right? So if I'm an angel investor in your company and I'm writing a $50,000 or $100,000 check, and I want you to get funded, so I'm not going to charge you anything to make some introductions to some of my friends who like to invest alongside of me. And so in the US, in a lot of ways, you don't need that person because people who are making angel investments or seed investments are very, very motivated to help the entrepreneurs have successful fundraisers.
Do you have time for just a couple more, or do you have to run?
One more, and then I've got to go.
Okay. Who takes the initiative on preparing the term sheet? Does the investor draft it and present it to the entrepreneur, or vice versa?
It varies. If you're raising from an institutional investor, namely a venture investor, it's almost always the investor that's presenting the term sheet, unless the investor is a small part of an existing angel round or a larger seed round. In contrast, I would say, if you're doing a round just with angels, it's quite likely that the person who's going to be writing the term sheet or providing the draft term sheet is the entrepreneur. So it can vary. If you're raising a seed or an angel round, I'd always suggest that you have a term sheet ready to go, but be looking for and willing to get a term sheet directly from an investor rather than being the one that provides it.
Great. Okay, Brad, thank you so much for joining us. We had so many questions, we didn't even get through them all. But thanks for joining us. And for those of you, again, who've perhaps only seen Venture Deals, Brad Feld has a number of other books on the startup community that has some pretty incredible, very valuable information for entrepreneurs and investors. Again, Brad, thank you for joining us.
Thanks a lot. See y'all.